Good afternoon, everyone, and welcome to Professional Advisors Working Lunch, brought to you with our partner today, Orbis Investments. I'm Katrina Lloyd, I'm Editor-in-Chief of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me run through our usual housekeeping with you. I should inform you this session is being recorded, and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending you proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So now let's get on with the session today. In Orbis's view, investing involves taking risks, but not blindly. In financial markets, prices move daily, and higher prices both increase risk and raise the bar for further returns. In the real world, some risks are costly to protect against, and some offer little compensation for sticking your neck out. But others are underappreciated, providing opportunities to generate attractive returns and mitigate risk at the same time. As Orbis looks at the world, it sees a few risks that offer both pitfalls and potential returns for investors: energy infrastructure, chip scarcity, and ongoing government deficits. Against a backdrop of high stock market valuations and high apparent faith in central banks, these risks point to a cautious outlook for broad markets, particularly if inflation proves sticky. But for a bottom-up investor, these same risks offer attractive pockets of opportunity. Delighted to be joined today by Orbis's Head of UK Retail, Matthew Spencer, who'll be explaining exactly what Orbis means by this and to offer some insights into some of their holdings and the reason they hold them. Do feel free to put your questions to Matthew using the chat function, which you'll find at the bottom of your screen. And we do want this session to be as interactive as possible. Now, just before I hand over to Matthew, let me quickly run you through our learning objectives for today. By the end of this session, delegates will be able to understand how the semiconductor ecosystem works and why energy is an important consideration for chip manufacturers, explain how the energy system works and which companies are likely to benefit from the energy transition, understand what impact government deficits have on opportunities within stock and bond markets, and understand how inflation affects multi-asset portfolios and inflation-resilient assets. So that's the CPD covered. Let's hear from Orbis's Matt Spencer. Afternoon to you, Matt. Thanks very much for joining us today.
Great. Thanks, Katrina, and thanks very much for having me. We do have a lot to get through today, so I'm going to jump straight into it. And when I was sitting back and putting these slides together, I said to myself, what would advisors value the most in learning in the current environment? So what I'm going to do is I'm going to speak about global stock markets and what we're currently seeing, and in particular, the valuations that we're seeing. I'm then going to hone in on two areas in particular. The first is semiconductors, and the second is energy infrastructure. I also want to speak about government debt and why we're staying well away from it, and then finish off with inflation, and in particular, what that means for a multi-asset portfolio. But before we do that, I realize that there's a different level of knowledge between the advisors on the call about Orbis. So I did just want to give you a little bit of an update in a nutshell. So in a nutshell, this is us. We're about 35 years old. We've got about 30 billion pounds under management. And the three words we use most to describe how we invest is fundamental, long-term, and contrarian. But what that really means on a day-to-day basis is that we spend 95% of our time picking listed companies apart around the world, just determining what they're worth independent from the market. And we're trying to find the 50 companies that are trading at the deepest discount to what we think they're worth. So what you end up with when you invest with Orbis is a very focused portfolio, very different from the benchmark, and will give you very different performance. And we believe in doing a few things and doing them well. And so here in the UK, there's only three funds that we do offer up and down the risk spectrum. So these are them over there. We've got global equity, which is long-only global equities, as the name suggests. We've got global balanced, which is a multi-asset portfolio, and then global cautious, which is the brother of global balanced, but as the name suggests, again, is a little bit more cautious. So we're on the 3, 6, and 9 sort of risk rating, if you're looking at the de facto risk rating. But if you blend those funds, you can create an offering which is suitable for any client, regardless of their risk spectrum. Now, if you look at the meat and potatoes, and before I do go forward, it's probably good to point out that what I'll be talking about today mostly concerns our multi-asset, so it's most relevant to our global balanced and global cautious funds. And so if you look at the meat and potatoes, this is how we've done over the years since we've launched the Global Balanced Fund. And the most important line, in fact, it's so important that I'm actually going to use the laser pointer here to highlight it, is this bottom line over here, because that's our net return after all fees and expenses. And essentially, the deal that we strike with our clients is that, hey, if you invest with us, in the fullness of time, you'll be better off investing with us than you would be if you were in a passive alternative. And that's after all fees and expenses. And so I highlight that bottom line because it's good to see that we have managed to stick to that deal. But while we're on this slide, the other thing I did want to point out is just look at that benchmark of the 60-40. The 60-40 has been an unbelievable portfolio to be in over the last 20 years. It's been very difficult to outperform. I mean, if you look at the peer group, I think it's underperformed the benchmark on all metrics. And that is great. And the 60-40 has been fantastic. But as we'll discuss a little bit later, we don't think that the 60-40 would be a good place to be in the next decade. And so here's another way to stack up the performance. And on the right-hand side is probably the most important numbers, and the one that we are most proud of is that 10-year number where we ranked second out of 107 funds. When you look at the performance like this, it stacks up very nicely. But that needs to come with a word of caution that, look, it's looking great now, but when you do build portfolios that are so different from the benchmark, there'll never be those years where we underperform. And sometimes that underperformance can be very uncomfortable. The other thing I'd like to point out is just if you look at 2022, one thing we do prioritize is not only return on our clients' capital, but also return of their capital. And so while the 60-40 and our peer group was down quite significantly, we were able to protect our clients' capital. It's no different with our cautious fund. I think the only difference is our cautious fund hasn't been around as long as our balanced fund, but it's put together by the same team with the same investment philosophy, et cetera, et cetera. Okay, that's enough on Orbis. Let's jump into the stock market. And I think the first thing I wanted to point out, and please, this is one of the key takeaways, is that regardless how you slice and dice stock markets, they are expensive at the moment. And I was standing up giving a presentation showing how expensive stock markets are on the CAPE ratio. And someone put up their hand and said, yes, on that metric, it looks expensive. But if you value markets on other metrics, they actually look quite good value at the moment. And so I went to my quant team and I said, can you put together a slide that takes all metrics and values the markets on all different metrics and show how expensive it is? And this is the slide that they came up with over here. Now, it looks a bit like a Jackson Pollock painting, but essentially what it's done is it's taken, I think it's the 12 most common metrics used to value markets, and it's put it onto one slide. And there is truth in at different times, different metrics are showing you that the market might be good value, and at other times it might be showing you it's quite expensive. But where all the metrics seem to come together are at the peaks and the troughs. So look, just before the global tech bubble burst back in 2000, all the metrics seem to converge. And when we had the global financial crisis in 2008, you'll see the metrics seem to converge as well. And if you look at where we are now, it's quite staggering. At the moment, stock markets have been cheaper 91% of the time. So regardless of how you slice and dice it, stock markets are expensive. And so when we come out with this message to our clients, they say, okay, well, that's great. I've heard enough. I'm going to stay in cash. I'm going to put my money under my mattress, but I'm definitely not going into equities. And we'd say not so fast, because yes, stock markets are expensive on aggregate. But if you look through, it's a small slither of the market that is driving that average up. And actually, if you're prepared to roll over enough rocks, there's actually still plenty of good opportunities to be found. And to show you how skewed this market has become, I went back to my quant team and I said, what is the visual that we can show our clients to show how concentrated the market has become? And they came up with this slide over here. And what they did is they said, right, we're going to take the 3,000 companies that are in the FTSE World Index. And the FTSE World Index is a great representation of world markets. And for those 3,000 companies, we'll rank each one on two metrics: how expensive they are on the x-axis, and then how economically sensitive they are on the y-axis. And when you do that, you get these quadrants, which all consultants and a lot of advisors love. You've got your value on the left-hand side, your growth on the right-hand side, your defensive or not economically sensitive on the bottom, and then your very economically sensitive or cyclical stocks on the top. And when explaining these quadrants over here, it's probably best just to give you an example of a company that would fit into each quadrant. And so in the bottom left-hand side, where you see the value defensive, I think British American Tobacco is a fantastic example. It's screening as extraordinarily cheap, and it's not economically sensitive. People still smoke when the economy's bad. In fact, they probably smoke a little bit more. Where if you go up to BMW, that company is screening as very cheap at the moment, but it is economically sensitive. You don't buy the new X5 when times are tough. Now, Louis Vuitton is a great one, which shows, growth cyclical, something that's expensive, but also economically sensitive. You don't buy a new handbag when the economy is stuck. But the most important quadrant is that one on the bottom right-hand side, which is where Apple is showing. Those are stocks that are screening as very expensive, but they're not particularly economically sensitive. People still use their iPhones or they still Facebook when times are tough. And so the quant team said, right, we'll rank all these 3,000 companies on those two metrics. And when they did that, it was quite underwhelming. This is what they got. And it didn't show a concentrated market at all. In fact, it showed a nice diffuse smattering of these companies across every single quadrant. And I said, ooh, that wasn't what I was expecting. And actually, if you want to show where the concentration in the market is, you need to adjust each of those dots for the size of the market cap in the index. And when you do that, you get a very different picture. All the money slides down into the bottom right-hand quadrant. And this is not a healthy market, because if you do take a stroll through time, and I've got a few bits of time here. Here's 2006. Here's 2016. This is what a more healthy market looks like. And you really can take any other time and you'll see that it is far more diffuse and far more well spread. In fact, we've only seen such concentration one other time in our lives, and that was back in 1999, just before the tech bubble burst. And so look at 1999 and look at today. It's starting to really run. And so what are those companies in the bottom right-hand quadrant that have hoovered up all the money? And I'm sure you've guessed it by now. It is the Magnificent Seven. And they have become extraordinarily expensive at the moment. And this is one of my favorite slides. What it does, on the left-hand side, it shows you how large the Magnificent Seven is in the index at the moment. And it's more than 20% of the world's markets. Now, that doesn't necessarily hit home immediately. But if you compare it to the right-hand side, which I've named the Mundane Seven, those are all the listed companies in Japan, the United Kingdom, Canada, France, Switzerland, Germany, and Australia. So said another way, if you wanted to buy all the Magnificent Seven, it would cost you the same as buying all the companies in Japan, United Kingdom, Canada, France, Switzerland, Germany, and Australia, which is absolutely nuts, especially when you consider the Magnificent Seven is only responsible for 12% of the world's profits, where that Mundane Seven is responsible for 32% of the world's profits. Now, why are we spending so much time on this? Well, there's a number of reasons. And the first, and I just want to go back to my chart over here, is our concern, and this is one of our biggest concerns, is that you've seen this flood of money going to passive. And one of the main reasons that you invest in passive is so you can get great diversification. However, if you're investing in passive now, not only are you not getting great diversification, but you're getting outsized exposure to the US and also to this big tech. The other thing I wanted to point out is, yes, as I mentioned, the markets are expensive in aggregate, being driven up by the Magnificent Seven. But if you're prepared to roll out over enough rocks, there's still plenty of good ideas to be found. And again, this is a chart from our quant team. And what it shows you is it shows you the number of companies that are out there that have potentially great return. And it says if the future is the same as the past, which is a big if, this is the number of stocks that'll give you more than 15% return. And so you can see after the global financial crisis in 2008, when things were incredibly cheap, there were a lot of stocks that were a good value. Similarly, when COVID hit and the market crashed, there were a lot of stocks that you could invest in that you could expect would be good value if the future was the same as the past. And sure, if you look at where we are today, it isn't as attractive as it has been, but it certainly, there isn't a dearth of ideas. There still are ideas out there. You just need to roll over a few more rocks. And so one of the areas that we found some good ideas is in the semiconductors. And the reason I wanted to speak about the semiconductors is because there's barely a client meeting that I go to at the moment where people don't ask about AI. And yes, AI is going to be transformative. It's going to be incredible. It's going to change how we do things, but we're not smart enough to know which company is going to win. It might be Google, it might be Microsoft. The truth is, it's probably a company that we've never heard of. And if you look at, so instead of trying to figure out the company that is going to win, what we've done instead is we've picked apart the entire ecosystem and looked at all the bits and pieces. And so, first of all, if you start off with the market's view, this is how the market sees AI. There's exactly two companies, NVIDIA and Microsoft, and both of them are going to the moon. They're going to do incredible. And if you look at a lot of our competitors' portfolios, they own a large chunk of both NVIDIA and Microsoft. Now, we find a few wrinkles with that, in particular, because what you'll find is that what's revenue for NVIDIA is actually expenses for Microsoft. And this is when it gets really interesting, because when you look at the consensus view that's on the street, you'll see that analysts are getting incredibly excited about NVIDIA, showing that sales in the future are going through the roof, but they're also excited about Microsoft, but the capital expenditure of Microsoft is not going through the roof, which doesn't really make any sense. To explain that a little bit better, we put this chart together over here. And what this chart shows you is NVIDIA's sales for the last couple of years, and then when it starts getting a little bit of light yellow, that's the future projections. And you can see people are excited about NVIDIA's sales. They're going to go up and up and up. But the people who buy their chips are the big tech companies like Microsoft, Google, and Meta. And if you look at their capital expenditure, and this is the same analysts who are looking at it, that isn't increasing as much. And so both can't be right. Maybe NVIDIA does grow and these green bars are correct, which means that actually Microsoft, Google, and the other big tech companies need to spend more. However, if the blue bars are right, then it suggests that NVIDIA's sales aren't going to be fantastic. And so when we look at NVIDIA, we look at Microsoft, we acknowledge the fact that they are fantastic companies, but they're just too expensive. The valuations are just too much for us to get into it. So the question we ask ourselves is, how can we enjoy the tailwind that is this AI, but not pay up for it? And one of the companies that we have invested in and are very excited about is TSMC, or Taiwan Semiconductor Manufacturing Company. Now, the reason we're so excited about it is, one thing a lot of people don't know is that NVIDIA doesn't actually make any chips. It just designs them. All of NVIDIA's chips are made by TSMC. They have become so complicated to make that TSMC is now the only company in the world that can make the most leading edge, cutting edge chips that you see on the logic side. You go back a few generations, it used to be Intel, Samsung, and TSMC. And if you go back even a further generations, there used to be 8 companies. But as the years roll on, the only company left now is TSMC. And so if NVIDIA does grow, it means TSMC is going to grow as well. And they're a fantastic company. When you go there to visit them, they've got these huge factories which cost billions of dollars to put up. They're about the size of a rugby field. And that's when they're making the latest chips. But at the same time, next to that is another factory which is just equally the size, getting up and running for making the next generation's chips. And so they're just investing a lot more than their competitors, and that's why they've been able to make the best logic chips. And so if you look at them, same tailwinds, just not the same price. Now, TSMC isn't the only company we're excited about. Here's a picture of NVIDIA's latest chip. And that foily thing in the middle is the brains of AI. That's what's going to change the world. That is making, millions of calculations every single second. That's what NVIDIA designs, and that's what TSMC makes. But if you look on the outside, you see all these memory chips. And the amount of memory that these chips are going to need is going to go up by a number of multiples because it needs to do all those calculations at the same time. And memory chips, unlike the logic chips, are quite commoditized. There's a lot of companies that can make them. And so, whether NVIDIA wins or someone else wins, they're all going to need these memory chips. And that's why when we look at them and we see the memory chips and we see the price they're trading at, we feel that's a very exciting way to enjoy the tailwind of AI without paying up for it. So if you go to the valuations, here's NVIDIA, which we don't own. It's trading at about 30 times earnings. If you look at forward earnings, so you say, okay, the market's excited about it, but we'll let them get that growth for the next 3 years. It's trading at 23 times earnings. Where if you look at the stocks that we do own, they have the same tailwind, they have the same growth prospects, but are trading at almost half price. And in the case of the memory chips, even less than a third of the price. And so this is quite incredible. I mean, one interesting thing is that not a lot of people realize, but this AI surge and these data centers and these big tech companies, it's not going to be the chips that are going to slow it down. It's not going to be the designing that's going to slow it down. It's going to be the energy that slows it down. I mean, they are so energy hungry. It's no coincidence that Amazon is building its next plant next to a nuclear facility. I mean, they just need so much energy. And that's quite a good segue into our next section, which is energy infrastructure, another area that we've been investing behind. And we have a number of positions in the portfolio. Now, when you think of energy and the energy transition, and you look in the press, this is usually the things that you see. You see a sexy windmill, or you see some solar panels, and we've looked at a lot of those companies. We really have. And there are some fantastic companies that are doing renewables, but they're just too expensive for us to put our clients' money in. So when we pick the whole ecosystem apart, the thing that we get most excited about is the boring stuff, like the substations, the transistors, and the cables. And to explain why, you probably got to go into what the energy system looks like at the moment and what we're moving towards. And so if you look at the energy system of the past, this is what you used to see. You used to have your fossil fuels, generating the energy, whether it was, normally coal. And then just below it, you had your peaker plants. And the peaker plants are those plants that can be switched on and switched off fairly easily. So when everyone's running their heating in the winter, you'd switch the peaker plants on and would provide more energy into the grid. That energy would then go into the grid, and through the transmission and distribution, it will be sent across, both to your home and to your industry. And so that's what we currently have at the moment, or have had in the past. Where we're moving towards is, especially if governments get the way, is that we're going to have more renewables coming into the generation part of the energy infrastructure. And that's solar, that's wind, et cetera, et cetera. Now, that's great, but there's one problem, and that's when the sun doesn't shine, you're not going to get much energy. And so the whole grid is going to have to be able to deal with intermittency. And so what does that mean? Well, it means two things in particular. These peaker plants, which are normally natural gas, are going to become more and more relied upon with this intermittency. And then number two, in the transmission and distribution, or the infrastructure, you're going to have a bigger ability to be able to store energy. And this is one of the areas that we have been investing behind. In fact, this is a picture of a battery plant in the US. It's a joint venture between AES and Siemens Energy, and it's something that we've invested behind. We've also looked at more sort of innovative ideas, and a little bit closer to home. You've got something like Drax, which has been tainted with the fossil fuel brush, but they're actually doing a lot of good things in the form of renewable. And one of the things that they do have is this pumped hydro, where energy is particularly cheap. They will buy the energy from the grid, they'll take the water, they'll pump it uphill through a dam and store it. And then when the sun stops shining or the wind stops blowing and energy becomes very expensive, it'll let the water flow through the dam again, generate energy, and sell it back to the grid at a profit. So a very elegant solution, and Drax is one of the holdings in the portfolio. But it's not only solar and pumped hydro. What you're also finding is that with wind, you're going to have to look at the cabling quite differently as well. So if you look at what we had in the past, you used to have a coal plant, maybe on a couple of acres of land. It would, generate the energy, and it would send it to a town which was maybe 10 or 15 kilometers away. That's no longer the case. I mean, if you look at the UK's biggest wind farm, just off the east coast of the UK, just in the wind farm itself, you need cables that are 462 square kilometers long in order to connect that wind farm together. Then the nearest town is 200 kilometers away. And so when we see this, we say, okay, well, who's creating these cables? And the undersea, the company that produces these undersea high voltage cables is Prysmian Group, and they're a fantastic company. I mean, their order book is booked out for the next 8 years, so you can see with some sort of precision on what they're going to be generating as revenue and net profits in the future. Yet the price that they trade at is still dirt cheap. So it's the kind of stuff that gets us twitching with excitement that we are investing in. Just one final thing on the energy grid of the future. It's not only the generation or the substations, but the consumption is also increasing. We're seeing more and more people move to electric cars, which is going to put more demands on the grid. But most importantly, we're seeing these AI data centers pop up everywhere. And this is huge. It mustn't be underestimated. I mean, they are very hungry for energy. In fact, it's estimated that in the next 10 years, just AI data centers themselves will consume more energy than the entire island of Japan, which is huge. And so when we look at this sort of energy system of the future, the conclusion we come to is that we're going to need more energy that can deal with intermittency, that can travel in a lot of places, in a lot of different directions. And when you put that all together, where we fall down on is mainly in the cables and the substation and the replacing of the equipment. And so if you lay the companies that we are invested in across the entire energy infrastructure, these are the companies over here. So you've got everything from the generation to the consumption, but most importantly, the infrastructure and the cabling. Now you move away from this without looking at valuations. So similarly, like we did, with the semiconductors, these are the positions that we hold in the fund. But at the top is Tesla, a position we don't hold. And when you put the valuations next to each other, you can see how stark they are. So Tesla is now trading at 135 times earnings. And let's say, give it the benefit of the doubt, it gets the earnings that the market says it's going to get over the next 3 years. It's trading at 110 times earnings still. You do that with the positions that we have in our portfolio, and you can see the starkness and the difference in valuations. And this is what gets us excited. Hopefully I'm bringing through the point that if you roll over enough rocks, yes, there are the expensive Magnificent Seven and a lot of expensive tech stocks, but actually under the surface, there still are bargains to be had. And so if you look at the rest of the equities that we're holding in our portfolio at the moment, this is what they look like at the moment. We've spoken about the semiconductors. We've spoken about the critical energy and infrastructure. And other themes in there that you'll notice is defense. Regardless of whether Trump pulls out of NATO or not, what we're going to find is that Europe, Japan, and other countries are going to have to start picking up the defense bill. This is something we spotted quite some time ago. Most of the main defense companies have done very well, but we've looked through the entire opportunity set and we found a few less known companies like Leonardo or Mitsubishi Heavy where we've been investing in. The other thing that I would say is that if you go through these companies, you're going to find that it's an eclectic mix of different companies, all with their own story, all that have gone through our process, all of which we know incredibly well, from what the business does to the management, to the valuations, their future plans, etc., etc. But there's two things that bind them all together. The first is that these companies position very well to do better in the next 10 years, which we feel is going to be a very different environment to the last 10 years. And the second thing that they all have in common, and it's shown in those bubbles on the right-hand side, is the price that they're trading at. So you'll see the valuations are not demanding, are not extended, in fact, at a deep discount to what the MSCI World Index is trading at. Yet the growth prospects or the fundamentals are as good as the market, if not better. So when we see that and we see the portfolio all together, we actually get quite excited about what's going to happen in the future. Now that's equities. We've spent quite a lot of time on equities. Now, I did say we are speaking about multi-asset. So the next thing I want to spend some time on is just, debt and inflation, and in particular, why we are staying so far away from government bonds. Now, if you look at the US and its debt to GDP, it's getting quite scary. Now, these are not our estimates. These are the estimates of the US government themselves, and we spend a lot of time in bond markets, and we actually think that these assumptions are incredibly conservative. And if anything, debt to GDP is going to increase at a faster rate than what you're seeing here. And this is a problem because, just think about it like a household. There's a point where you're no longer running the household, and your leverage is no longer working for you. You're working for your debt, and more of the take of the US government is being spent on interest. In fact, the US government has to issue more debt in order to pay for the interest. And it was this year where interest for the first time cost more than the US military itself. And so you started to get into this spiraling downfall where you've got these large deficits. So you issue more debt, which costs more to service. So you issue more debt, and so on and so forth. And so with this huge supply of government debt, we just feel that it's not the place to be, and we are staying well away from it. Now, interest is becoming very taxing for the US government to service. And if you read in the press, the good news is interest rates are coming down, so that they'll take some pressure off. But we're not so sure that that is the case. In fact, what we worry about is that inflation is going to be stickier for longer, and that interest rates might be higher for longer. And why is that? Because inflation is the one number that central banks really care about. And so when they see it rearing its head, there's really only one instrument they can use to fight it, and that's increasing interest rates. And the reason that we think inflation might be higher than what the market is currently pricing in, the market's currently pricing in about 2 or 3%, is for a number of reasons. But there's 4 main reasons. The best way to explain it is that something is inflationary if it's not productive. In other words, if you spend money and it doesn't increase proficiency or production. And there's a number of those forces which are happening at the moment. The first is a swing from capital to labor. I think after the global financial crisis, you saw this huge swing to capital. You saw this globalization where every single red-blooded capitalist was taking their factories out of the US and putting it into Southeast Asia. So you had this cheap labor, this globalization, which was bringing costs down, and that was fantastically deflationary. However, you're seeing the opposite of that now. You're seeing the end of globalization. You're seeing Trump saying, let's reshore things back to the US. And he might do it, but if he does, the labor is going to be more expensive, and that's going to be more inflationary. The second thing is that even the labor that you have now, if you want to keep the talent, you've got to pay more and you've got to get more benefits. So again, that's going to be more expensive. And again, it's going to be inflationary. The next thing is that we're seeing this energy transition. We're seeing more and more countries, especially in Europe, push towards green energy. And that's great. It might be the right thing to do. It might save the environment. It might save the world, but it's going to cost a lot of money. It's estimated it'll cost $90 trillion. And what you're going to have at the end of it, you're going to have energy. So it's unproductive. So it's going to be inflationary. And then the next thing, which we mentioned a little bit earlier, is that it's the end of the peace dividend. I think since the end of the Cold War, most countries have been able to say, right, you know what, I'm not going to spend that much on GDP, on defense, that much of my GDP on defense. I'm going to scale it back. That's ended now. You're going to have, all countries are going to have to spend more money on defense. And that, again, is not productive. So it's going to be inflationary. So when we see that the market is pricing in, between 2 and 3% inflation, we wouldn't be surprised if it's a little bit higher and a little bit sticky. Now, that's important, especially if you are running a multi-asset portfolio. And the reason I say that is this is a great chart which shows the relationship between stocks and bonds and inflation. And these, if we could just concentrate on these red dots over here, the green dots and the dark blue dots, what it shows here is that inflation has been low, and this is for the last 25 years. And the relationship between stocks and bonds have been negative. And this is such an important point. And this is why the 60-40 has been so successful, because you've had this negative correlation between stocks and bonds. And so when stocks are zigging, bonds are zagging. When the market drops, you get saved by bonds, and vice versa. And it's been a fantastically reliable negative correlation that you could rely on. However, if you go back further in time, whether it's the 70s or the 80s, you'll notice above here that as inflation gets higher, that correlation between stocks and bonds starts falling apart. And why is that so important? Well, that's so important because if you look at the portfolios that advisors are putting together, or most people are putting together, it's the 60 equities, 40% bonds, in the anticipation that there would be this negative correlation between stocks and bonds. We're not sure that you can rely on that relationship going forward, because it flips if inflation is higher than expected. So just to finish off, how are we positioning the portfolio, or how are we navigating the current environment? Well, this is normally a useful slide over here, which shows the index on the left-hand side, so the classic 60-40, 40% government bonds, 60% global equities. And then on the right-hand side, that's what our balanced portfolio looks like. And so we've spoken quite a bit about equities. We're rolling over a lot of rocks. There's quite a few equities that we are excited about, but you'll also notice that we slightly underweight equities because markets are expensive. But more importantly, if you look on the government bond side, we barely have any government bonds, and we've replaced that with a bunch of different securities. Number one is gold. We feel that in these sort of environments where there's a lot of distrust in the system, gold does particularly well. And we'd rather hold gold than we would government bonds for the reasons I've just explained. Any government bonds we do hold are inflationary protected. So if inflation is higher than expected, those bonds will do very well. And then the few government bonds that we do have are not from the US, they're more from the Scandinavian countries that have a large surplus rather than a deficit. So countries we'd rather invest behind than, say, the US. And then there's a smattering of corporate bonds of companies that we know very well. We feel their credit risk is adequate enough to take on, given how well we know those companies. But just below that, we've got the hedged equity. And this, to a large extent, is replacing what most balanced portfolios have in bonds. And so how does that hedged equity work? Well, it's fairly simple. What we do is we invest in our best stocks, and then we hedge out the market risk by selling a basket of futures. And what you end up with is our stocks versus the market. And so to put it in the most simple way, if the market collapses by 20% and our stocks only collapse by 15%, then that hedged equity would actually be up by 5%. And why are we so excited about hedged equity at the moment? Well, it's obviously going to work the best when there's a wide dispersion in valuations in the market, which is what we're currently seeing, as I explained with those quadrants. So we would be short the Magnificent Seven and long the stocks that we own. So if that does come back, that hedged equity will do exceptionally well. And because we have such a different portfolio, and because we look very different from the benchmark and our peers, our performance is very different. And this is one of the key takeaways that I wanted to impress on everyone today, is that if you look at the top 10 funds that are used by advisors in the 40 to 85 space in the UK, these are the funds over here. Now, obviously, for compliance reasons, we couldn't list the funds' names. But what this chart is showing you is just how correlated those top 10 funds are. And that's an important point to mention, because what we fear is advisors think, or clients think, that they're well diversified because they're putting their money across a lot of different managers. But actually, those top 10 funds are behaving very similarly. And the reason for that is that most of those top 10 funds are passive funds, and those that are active are exposed to growth stocks rather than to value stocks. And so all in that bottom right-hand quadrant, which I showed earlier on, so they behave very much the same. So when you have a year like 2022, where both stocks and bonds struggled, those top 10 funds behave very similarly. At the bottom over there is our global balanced fund and its current correlation with those top 10 funds. As you can see, it behaves very differently from the top 10 funds. And this is the message we're trying to get out to the market is, hey, maybe consider our balanced fund as a diversifier because it will give you a true diversification. And then when the drawdowns do come, you will draw down less, but it won't be at the expense of your returns. And this is what has happened in practice. So if you go to this chart over here, what we've done is we have created 3 portfolios. You've got the peer group in red. Then you've got the most popular mix, which is in the light blue, which is 50% passive and 50% growth. And then the top, which is the darker blue, is one that's 25% passive, 25% growth, but then mixing in the contrarian value, which is our global balanced fund. And what you'll see is as the drawdowns come, if you've got that mix of contrarian value, they're less sharp than the peer group or the most popular portfolio, which is out there, which is 50% passive and 50% growth. Now you might say, okay, well, have returns suffered as a result? And the answer is no. Here's the same 3 portfolios. And since 2013, had you had those 3 portfolios, you actually would have been best off being in this 25% passive, 25% growth, and 50% contrarian value. So I think the message we're trying to say is just think about balancing that blend, adding something which is truly diversified, which is going in the opposite direction of the market, which isn't invested in those companies with sky-high valuations, because it can be good for your clients, especially in the time of a big drawdown. So just going back to our final slide over here, again, this is our promise that we make to our clients after all fees and expenses. That bottom line over there should be positive, and I'm glad to say that it has been over the history of this fund. So thank you very much. I'm going to leave it there, and Kath, I'll give it back to you to see if there's any questions.
Great. Thanks so much for that, Matt. Thanks for sharing your views there with us. We do have 2 similar questions about TSMC. So I'll read the first one. It sort of covers the queries from our audience here. And just a reminder, please do put any other questions for Matt in the questions box there. So the question is, are you not worried about the current China-Taiwan tensions when looking at TSMC future returns? Or are TSMC outsourcing factories abroad?
Yeah, so I think, look, I think that's a great question, and to answer it just directly, yes, absolutely, we are concerned. And so, what do you do in a situation like that? I think the first thing I'd say is that TSMC is probably the best company in the world, and if it was in the US and it was trading at these valuations, it would be 10% of our fund. And if we could make it 20% of our fund, it'd be 20%. That's how attractive it is from a valuation standpoint. But as you point out, you've got this Taiwan-China risk, which is very different to quantify and to see how that's going to play out. We feel that the valuations are so cheap that we're being compensated for that, but you do have this tail risk. So how do you deal with that? The first thing is in position sizing. We would love it to be 15%, but because of that risk, we hem it down all the way to a maximum of really 3.5%. So that's how we control the risk from that perspective. The second thing is that if there is an invasion of China on Taiwan, it will really hurt the Taiwanese dollar. So we hedge out that Taiwanese dollar risk. So we invested in TSMC, but we hedge out the Taiwanese dollar risk. So we manage the risk from that perspective. Then the second thing is as you pointed out, you've got the US government giving TSMC a lot of money, saying, hey, come build your factories here in Texas or wherever you want to build them. Just get out of Taiwan. And they, as anyone would, are taking up those grants and they are building those factories. But there's no ways that they're going to take their most cutting edge factories and move them out of Taiwan. I mean, absolutely. Why would you do that? TSMC is the world's most strategically important country. and that is why Taiwan is worth defending. So if they moved all the assets to the US or somewhere else, and the main cutting edge fabs, then they might not be worth defending as much. So they're not foolish in that regard. So yes, you read in the press a lot that they've got these grants, and that's all true, but really the heart and the soul of TSMC is very much in Taiwan, and that's not going to change.
Thank you for that. I wanted to ask you, I mean, you're obviously out there talking to advisors a lot, including on coming to a lot of our professional advisor events and speaking there as well. And what are some of the key issues that they're raising with you at the moment at the start of this year? A lot happening for investors. What are some of their key issues that you're picking up?
Yeah, so there's two things that I'd point to. The number one is, sure, where do we put our clients' money when valuations are so high at the moment? That's the number one thing. The second thing, which is related, is this concentration risk. I think that slide that I showed on how the top 10 funds just behave exactly the same way when a market event happens is frightening. And so we're seeing more and more advisors come to the conclusion on it, shucks, how do I get truly diversified here? Because spreading it across the funds is not going to do the job. And that's something which is front and center of their minds. And I think that what we point to is absolutely, it should be front and center of your minds. And 2022, when we saw the big drawdown, that was just a dress rehearsal, what could be coming in the future. And so you've been given almost a warning shot. And so I think it is the right thing for advisors to be looking at their portfolios and saying, hey, are we truly diversified? How much exposure do we have to the US and these big tech names and all these speculative stocks? And so that seems to be what's front and center on advisors' minds. The other thing, which I also point out, and this is why I think advisors are in a fantastic position and always going to be relevant, is that how do they navigate their business and their clients through the recent changes that have happened in the budget and the regulatory environment. That's the other thing which seems to be on their minds.
Great. And obviously this week, Trump, the inauguration of President Trump, and a lot of discussion around what that's going to mean for markets and portfolios. What's your sort of perspective on what this could mean? And obviously we've got sort of policies that he's announcing day by day now.
Yeah, so I think, look, it's too early to tell, but the initial gut feel is it just strengthens our resolve in that, boy, we are happy that we are underweight the US. And that isn't a slight at the US. I mean, the sentiment in the US now is so positive. There's this sort of euphoria about US exceptionalism, and it's leaking into the markets, and you're just seeing share prices go up and up, and a lot of companies' share prices have now become, untethered from fundamentals. And you're seeing a speculative environment as well. I mean, I don't know if you saw, but Trump launched his meme coin, and it got up to $14.5 billion in market cap just in a couple of days. I mean, it shows you the speculation and the euphoria across there. And so when we see that, and we're a manager that makes all its investments based on valuations, that worries us that there's a lot of froth in that market. And then we look at the portfolio and say, well, hang on a second, we really underweight the US, and that makes us feel a lot better. I think the other thing I'd point out is I got the question the other day, and hang on a second, it's a Republican government. They're normally small government, less spending. There is no signs that Trump is going to spend less. Number one, so that makes us even more excited that we are very short long-term US government bonds. But number two is the thing that we can't square off is that Trump essentially came to power with the slogan, hey, are you better off now than you were 4 years ago? And there's very few Americans, or actually very few people in the Western world, that could actually say, yes, I'm better off now than I was 4 years ago. And that's what brought him into power. And he was like, look, we'll get the cost of living crisis under control, inflation, et cetera, et cetera. But if you look at the policies that he's implementing, they're all inflationary. Well, a lot of them are inflationary. So, for example, the tariffs that will come in will be inflationary. This mass deportation, if it does go through, is just going to result in higher labor costs, which is going to be inflationary. Saying, hey, get back on shore, get out of Southeast Asia and get your factories back into the US, that's going to be hugely costly and hugely inflationary. And so how is he going to square that off is left us scratching our heads. We think it's going to be very difficult, and it just sort of feeds more to the thesis that we have that inflation is going to be stickier for longer. Katrina, I think I've lost you. Are you still
No,
there?
I'm here. Yeah, I'm going to ask you another question quickly. My computer was just playing up slightly. So, yeah, and could you tell us a little bit about, Trump's, policies on renewables? Isn't that going to hurt some of the energy transition and infrastructure stocks that you alluded to?
Yeah. I mean, I think the first thing I point out, and very important to note, is that we are not in these renewable companies, these wind farms, these solar, et cetera, et cetera. We did look at them. Some of them are great companies, they're just too expensive. Really, what we are in is the infrastructure, and it is so dilapidated, and this is why you're going to see more fires. There's a huge replacement that needs be. So whether we are producing energy from fossil fuels or renewables, the infrastructure is going to need an upgrade. And so, Trump's policies, if he pushes more towards fossil fuels, is not going to change that fact. And the other thing that I would point out is that one of our larger positions is Kinder Morgan, which is the pipelines for the natural gas in the US. And Trump's policies, if he does drill, baby drill, would certainly be positive for that. Now, the markets recognize that, and it has bounced quite considerably, so I wouldn't be surprised if we're trimming it soon. But actually, if you look at it, the policies that Trump is pushing through are net a positive for our portfolio.
And I wanted to refer as well, we're talking about advisors and some of the challenges they've had, especially around the budget in the UK. If at all, how has the UK budget impacted your portfolio and that opportunity set within the UK market?
Yeah, sure. So I think that I put it into two camps. Firstly, just from a business perspective, I think the UK budget was actually a net positive for Orbis because the capital gains changes, I think, makes multi-asset a little bit more palatable than MPS, and we run multi-asset funds. So that was a positive. On the actual investing perspective, I mean, I've only arrived in the UK, 6 months ago, and I used to live here 10 years ago, and I've never seen the sentiment so low. I mean, you go to the US and you've got this euphoria, and you come to the UK and everyone seems to be down in the dumps. And I realize there's a little bit of a difference in the makeup of Brits versus Americans, but that's even wider than usual. And so when we see this negative sentiment, and you've seen outflows, and it's difficult to attract investors, that's the kind of stuff that gets us excited, because if you look at the valuations in the UK, they've sunk to incredible lows. And so we've tried to look through that, and we have found some exciting companies, whether it's Rolls-Royce, which is more a global phenomenon, or some of the UK house and home builders, which are incredibly cheap and arguably do have some tailwinds behind them now, to very sort of idiosyncratic stocks that each have their own story, but we're attracted to them because they have been so cheap, and it's because of this real sort of grey cloud that's been resting over the sentiment in the US, in the UK, and the UK market.
Great. And just finally, we've just got a final sort of question here, observation. In listening to your presentation, looking at behind the scenes investments, I'm reminded of, an adage that during a gold rush, the person that most reliably made money was the one who sold tents, buckets, and shovels to the miners. Would you say that you're pursuing a not dissimilar strategy?
Absolutely. I mean, absolutely. We wouldn't even hide from that fact. I mean, in fact, that's an analogy that I've used myself in the past. The people who made the money were selling the tents and the pitchers and the shovels, et cetera, and it's a lesson we had to learn the hard way. And so when you saw in the the smartphone secular tailwind of smartphones were coming in, we realized that it was a secular tailwind, which is the horse we're going to back, and we ended up backing BlackBerry or Research in Motion. And you can imagine what a painful investment that was for us. And so when we reflected on that, we said to ourselves, how do you actually pay these secular trends? And the truth is, and I'll say it again, we're just not smart enough to figure out who's going to be the big benefactor or the company that's going to win a particular secular trend. We don't think anyone is smart enough to do that. So instead, what we do is we say, okay, well, what are the things that they're going to need in order to be successful, regardless of who wins? And so when we look at the smartphones again, we should have invested in Corning, who make the screens, or Micron, who make the semiconductors, because whether it's Apple that's winning or whether it's Research in Motion that's winning, they're all going to need those parts. And that's exactly what we're doing with AI. We realize that they're going to need these logic chips, they're going to need these memory chips, regardless of who wins. So let's back those individuals. And so yes, not even trying to hide from that fact.
Yeah, nice image there. I'm sure as you said, one you can use when you're presenting as well. Well, thanks so much for that, Matt. Thanks for joining us. Thanks for taking our questions today. Just before we wrap up, let's take another quick look at those learning objectives again. I'll just find them on our slide here. Let's get back to that one. Okay. So learning objectives: understand how the semiconductor ecosystem works and why energy is an important consideration for chip manufacturers. Explain how the energy system works and which companies are likely to benefit from the energy transition. Understand what impact government deficits have on opportunities within stock and bond markets, and understand how inflation affects multi-asset portfolios and inflation-resilient assets. So those are our sort of learning objectives for today. Again, a reminder, we'll be sending the CPD out to you. Thanks very much. If you didn't get your question answered today, I'm sure Matthew and the team at Orbis would do their best. So please do send your questions to them after the event, and the CPD will be delivered tomorrow. Just before we close, just a quick reminder of what's to come from PA events in the first quarter of 2025. It's going to be a busy time. We're on the road again in February with a subtle change to our Q1 multi-asset roadshow, which has been renamed the Multi-Asset MPS Roadshow. That's starting in Leeds on the 4th of February, followed by Warrington on the 5th and Coventry on the 6th. And then the following week will be at Lee Court in Bristol on the 12th and finishing in London on the 13th. And we'll have 6 presenters there from BlackRock, Clever Advisor, Morningstar, Momentum, Orbis and Quilter Cheviot. And our keynote speaker will be De Facto's Insight and Consulting Director, Paul Tinkler. On the 19th of March, we'll have 2 events for you. At lunchtime, we're running the next in our series of digital working lunches. We'll be joined by Hamish Maxwell, investment specialist with the Scottish Mortgage Investment Trust. And then on the evening of the 19th of March, we're returning to the brewery for the Professional Advisor Awards. 500 of us will gather to celebrate the very best in the industry and reveal the UK's best financial advisors to work for. So don't miss out on a spectacular evening. So all in all, that's a total of 4 hours CPD over the next 10 weeks, as well as a fantastic night with the great and good of our industry. And as ever, if you wish to find out information or sign up to any events that we're running, you can do so by going to professionaladvisor.com/events. So that's it for today's working lunch. All that remains is me to thank Matt again once more for his presentation. Thank you all very much for your company and for your questions. I hope you found the session helpful and worthwhile, and we hope to see you again at another Professional Advisor event very soon. Goodbye.